we're running out of extra dollars. And you can see that because the dollar supply is contracting, because the Fed counts it up to the dollar every month. And it's shrinking. So like, who's going to buy these auctions? I don't know. And what happens then?
Welcome to an in-depth exploration of the silver market, where recent dynamics suggest the onset of a significant bull run. Silver, often referred to as the poor man's gold, is capturing the attention of market participants as evidenced by its resilience in the face of recent fluctuations. Join us as we analyze key indicators surrounding silver, XAG/USD, to unravel the intricate details that hint at an imminent surge, potentially marking one of the most substantial bullish trends in recent memory. In the latest turn of events, silver has managed to turn the tide by attracting dip buying on a consequential Tuesday, effectively breaking a two-day losing streak. Currently holding its ground in the $23.85 to $23.90 range, the white metal exhibits a commendable 0.3% gain for the day. This resurgence follows a recent recovery from the mid-$22 zeros, a level not witnessed in a month and a clear signal of the market's ability to withstand downward pressures. However, as with any market analysis, the technical landscape is crucial for a comprehensive understanding. The recent rebound, while encouraging, encountered resistance around the 50% Fibonacci retracement level of the downfall from the December swing high. This level, serving as a crucial psychological marker, has yet to see silver find complete acceptance. Adding complexity to the analysis, oscillators on the daily chart, despite recovering from bearish territory, are still in the process of gaining positive traction. This intricacy warrants a note of caution, particularly for aggressive bullish traders eager to capitalize on the upward momentum. The subsequent pullback, though limited, is significant. It allows XAG/USD to maintain its position above the critical 200-day simple moving average, SMA, currently positioned around the $23.60 mark. This SMA acts as a key pivotal point of sort of financial equilibrium. Should a convincing break below occur, the stage would be set for a vulnerability test below the $23 level, with the additional threat posed by an ascending trendline support originating from October. As we continue our journey through the intricate world of silver, XAG/USD, it's imperative to address the challenges and opportunities that lay ahead. The technical aspects of this market offer a nuanced perspective, demanding a thorough examination for anyone looking to capitalize on potential gains. The current resilience of XAG/USD is notable, with the white metal managing to hold above the crucial 200-day simple moving average, SMA, positioned near the $23.60 region. This level serves as a linchpin, a key support that, if convincingly breached, could expose the market to sub-$23 levels. Adding further complexity, an ascending trendline support extending from October further emphasizes the significance of maintaining this support. On the upside, the $24 mark emerges as a critical resistance, representing a psychological barrier that silver has struggled to overcome in recent sessions. Beyond this point, the $24.25 $24.30 region, corresponding to the 50% Fibonacci retracement level, poses a formidable challenge to sustain upward momentum. Aggressive bullish traders should exercise caution, as oscillators on the daily chart, though on a recovery path, are yet to firmly establish positive traction. However, should the bulls manage to breach the resistance and propel XAG/USD beyond $24, a fresh trigger for bullish traders may emerge. The path beyond this point remains dotted with hurdles, including the aforementioned resistance zone and the psychological $25 mark. Further, an intermediate hurdle at $25.25, followed by the $25.45, $25.50 region, adds layers of complexity to the bullish narrative.
In my head. So if reverse repos are zero at a time when interest rates are 5%, so who is buying all of these treasuries on the primary market in the treasury auctions? Where are the dollars coming from? If the dollar supply is shrinking, there's got to be new dollars to buy these treasuries, right? So they must be coming from somewhere. They're coming from the reverse repos. We know this because every time there's a new treasury auction, the reverse repos shrink, right? So they're coming from the reverse repos. So if there's no reverse repos, who bids on the treasury auctions? And maybe people can come up with another possibility when in 13 weeks, it's a rough estimate based on how fast they're shrinking. It could be 13 weeks, 15 weeks. it could be weeks off, but what does it matter? We're talking about like a 50, 60 year fiat monetary experiment here. And we're talking like we're trying to get into a precision of weeks, and I can't really do it exactly. But okay, so let's say 13 weeks. So who buys these things? The answer is I don't know. I mean, there's some theories out there of articles that I've read that the reverse repos, instead of people lending cash, instead of banks or money market funds, whoever they are, lending cash to the Fed, getting securities in return. So when they run out of cash, okay, so fine, they'll lend securities to the Fed in exchange for cash with which they'll buy treasuries, but then they have to return the treasuries to the Fed the next day. I mean, this thing becomes very, very tight. And again, like, I'm speaking as if I'm an expert, but I admit that I'm not, and because nobody really is, and even Jamie Dimon isn't, and because if he was, he would have predicted the apocalypse in 2019, but something like the apocalypse is going to happen again. And some kind of treasury auction is bound to fail if there's no money in the system to buy those securities. Exactly when that happens, I don't know, but I can see the same thing happening now. Not the same exact, but something parallel happening now to what happened back in 2019, because we're running out of extra dollars. And you can see that because the dollar supply is contracting, because the Fed counts it up to the dollar every month. And it's shrinking. So, like, who's going to buy these auctions? I don't know. And what happens then?
In the final lay of our exploration into the dynamics of silver, XAG/USD, we delve into the prospective milestones that could define a remarkable bull run. The journey ahead for silver traders is laden with critical junctures, each holding the key to unleashing a potential surge in value. As the price of silver lingers around the $23.85, $23.90 range, having broken free from a recent two-day losing streak, the momentum appears poised for further examination. The market's recent recovery from the mid-$22 zeros, albeit commendable, faces challenges in securing acceptance above the 50% Fibonacci retracement level. The cautious optimism is underscored by oscillators on the daily chart still on the path to gaining positive traction. Maintaining a crucial position above the 200-day simple moving average (SMA) at $23.60 is paramount for sustaining the upward momentum. A breach below this level would not only jeopardize the current bullish sentiment, but also expose the market to potential tests below $23, with the looming threat of an ascending trendline support originating from October. Conversely, conquering the $24 mark is a significant milestone for the bulls, unlocking a path that includes overcoming resistance at $24.25, $24.30, and the psychological barrier at $25. A sustained breakthrough at these levels could pave the way for an extended rally towards the $25.45, $25.50 region, with the ultimate goal being the $26 neighborhood, a level not seen since May 5 earlier this month. It's essential to approach this analysis with a degree of caution, acknowledging the uncertainties inherent in financial markets. This exploration is not an endorsement of a specific trading strategy or investment decision. Market dynamics are subject to rapid changes, and individual risk tolerance and financial goals should always guide investment choices. This analysis is not investment advice. It is crucial to consult with a qualified financial advisor before making any investment decisions, ensuring alignment with your unique financial situation and goals.